How are publicly traded stocks taxed according to the IRS? In the United States, the Internal Revenue Service, IRS, generally taxes profits from the sale of publicly traded stocks as capital gains. The tax rate you pay is determined primarily by how long you own the stock before selling it. Short-term capital gains. If you buy a stock and sell it for a profit within 365 days or less, the profit is considered a short-term capital gain. These gains are taxed at the same rates as your ordinary income, like wages, which can range from 10% to 37%, depending on your taxable income and filing status. Long-term capital gains. If you buy a stock and hold it for more than 1 year before selling it for a profit, the profit qualifies as a long-term capital gain. These gains are taxed at lower, more favorable rates, 0%, 15%, or 20%. The specific rate depends on your overall taxable income and filing status. Dividends. If the stock pays a dividend, that income is also taxable, but the rate depends on the type of dividend. Qualified dividends. These generally meet certain IRS requirements, including a minimum holding period, and are taxed at the same lower preferential rates as long-term capital gains, 0%, 15%, or 20%. Ordinary non-qualified dividends. These are taxed as ordinary income at your regular tax rate. Capital losses. If you sell a stock for less than you paid for it, you have a capital loss. Offsetting gains. You can use capital losses to offset or reduce your capital gains. Deductible losses. If your total capital losses exceed your total capital gains for the year, you can deduct up to $3,000 of the net loss, or $1,500 if married filing separately, from your ordinary income. Any remaining loss can be carried forward to offset income in future years. Net investment income tax. High-income taxpayers may also be subject to an additional 3.8% net investment income tax on certain investment income, including capital gains and dividends, if their modified adjusted gross income exceeds certain thresholds. Tax reporting. Your brokerage will issue you IRS Form 1099-B, proceeds from broker and barter exchange transactions, which summarizes your sales and reports the basis or original cost of the stocks you sold. You use this information to calculate your capital gains and losses on IRS Form 8949 and Schedule D of your tax return. For more tax and investment information, we welcome you to subscribe to our YouTube channel and to learn about our law firm's investment and financing legal practice, visit our website. Thank you.